Welcome back to Dinar Community. Shockwaves are spreading through international financial markets after a confidential leak from a high-level institutional Forex algorithm hinted at a stunning possibility. The Iraqi dinar IQD could stabilize at a value of $7.70 per unit for a sustained 30-day period. This revelation hasn't just energized seasoned IQD holders, it's also sparked intense conversations among global investors, central banks, and geopolitical analysts. For years, the dinar was largely seen as a high-risk, long-term speculative asset, often buried beneath waves of false revaluation rumors and misinformation. But this time, it's different. This leak stems from a sophisticated predictive system reportedly developed by an elite currency strategy team linked to a major European investment institution. The system doesn't rely on guesswork. It uses AI-powered data modeling to analyze global liquidity, regional trade patterns, and geopolitical alignment. Its past accuracy in forecasting currency moves in volatile economies has made this current projection nearly impossible to ignore. If the model proves correct, it could be the most significant turning point in the dinar's modern history, and perhaps a key trigger for a global realignment in currency values. For those who've waded through years of false starts and manipulated narratives, this might be the breakthrough moment. Where the $7.70 prediction originates. The bold projection comes from a confidential AI-based algorithm designed to interpret thousands of data streams, from international capital flows and commodity trade dynamics to central bank liquidity behavior and debt cycle synchronizations. This isn't driven by retail hype. It's a calculated forecast emerging from deep institutional research, previously guarded but now whispered about in major financial centers like Zurich, Dubai, and Singapore. The model has a track record of successfully anticipating stabilization patterns in unstable economies, making it difficult to dismiss this forecast as mere theory. Crucially, the model cites Iraq's rising foreign reserves and oil-fueled trade alliances as key stabilizers, helping anchor the currency in a way previously unseen. The silence from Iraq's central bank, typically quick to comment, has only fueled speculation that something major is in motion. Institutional silence and operational shifts. Since early June 2025, the Central Bank of Iraq (CBI) has gone unusually quiet, avoiding commentary on rate policy or monetary moves. Historically, such silence precedes major currency interventions. Adding to the intrigue are reports from U.S. redemption centers indicating restricted access to high-denomination dinar notes and tighter verification protocols, a pattern that has echoed past currency reset behaviors, such as Kuwait's post-war currency overhaul. Vietnam and Zimbabwe are showing similar patterns. Vietnam's central bank has initiated covert audits tracking offshore movements of the dong VND, while Zimbabwe is reinforcing audits on gold reserves following legislative currency reform. Analysts are increasingly viewing these as signs of an orchestrated, multinational monetary event in the making. Whether it's deliberate coordination or synchronized timing, one thing is clear: central banks are preparing, quietly but methodically. Market reaction. A sudden shift in behavior. Once the $7.70 projection circulated within Forex circles, institutional money started moving fast. Hedge funds that previously avoided the dinar due to its political and regulatory uncertainties are now entering the market through discrete intermediaries. Trading volumes in currency futures tied to Middle Eastern baskets have surged, and OTC Forex platforms in Canada, Germany, and GCC nations report transaction backlogs due to bulk IQD demand. Retail investors, typically slower to act, are now rushing in, fearing they may miss what could be a once-in-a-lifetime opportunity. Analysts are calling this a panic entry phase, driven not by speculation alone but by actual institutional behavior and modeling data. As liquidity tightens and demand skyrockets, the dinar has emerged from the shadows into the spotlight as a legitimate financial play, complete with risks, volatility, and staggering potential rewards. Watch the ripple effects. VND and ZWL in focus. While the spotlight is currently on Iraq, financial experts are keeping a close eye on the Vietnamese dong (VND) and Zimbabwean dollar (ZWL). Vietnam has spent the past year quietly modernizing its monetary systems, integrating digital finance frameworks that align with ASEAN initiatives and China's Belt and Road strategy. Insiders in Hanoi report that interbank discussions have recently turned to rate adjustments, mirroring Iraq's run-up to its $7.70 forecast. If Iraq holds its projected rate, Models suggest the VND could revalue within a range of $3.90 to $4.10. In Zimbabwe, the passage of gold-backed currency reforms in May 2025 has laid the groundwork for a potential valuation breakthrough. Provided the IMF signs off and the country maintains its reserve integrity, analysts believe the ZWL could stabilize between $1.25 and $2. Why a 30-day lock window matters. A common question surrounding the $7.70 projection is why the specific 30-day window is significant. In Forex terms, a lock period doesn't mean the rate is frozen like a fixed peg, but that a tightly controlled price band is enforced, usually supported by active central bank interventions, liquidity provider commitments, and institutional agreements. This window allows global financial infrastructure to recalibrate, banks update systems, redemption centers validate node legitimacy, and digital payment protocols align. Psychologically, it provides certainty to markets, encouraging organic transactions at the new rate and reducing fear of sudden reversals. Without this stability, the market risks chaos. With it, the transition can occur smoothly, turning a speculative scenario into an established norm. Expert opinions now emerging. For years, top economists stayed quiet on the dinar's potential. That silence has now been broken. Dr. Elijah Ford, a respected macro strategist formerly with Deutsche Bank, explained, $7.70 isn't random, it reflects Iraq's realigned GDP, oil production, and increasing financial sovereignty. London-based Forex expert Melinda Kershey noted that IQD trading patterns resemble the euro's early days of stabilization back in 1999. Even traditionally cautious think tanks like the Middle East Economic Forum have conceded that Iraq's fundamentals could support rates above $5, making $7.70 ambitious but not unrealistic. Still, geopolitical risks remain. A surprise move by the IMF or U.S. Treasury could change everything. That's why vigilance is key. Final thoughts. Preparation over speculation. Whether you hold IQD, VND, or ZWL, this could be the moment that reshapes the entire currency landscape. What once was dismissed as fantasy is now supported by modeling, insider behavior, and global positioning. Currency holders must act smart. Verify your holdings through certified dealers. Update identification documents to avoid delays in redemption. Monitor central bank activity in Iraq, Vietnam, and Zimbabwe. Stay alert for IMF and regional policy shifts. Most importantly, don't wait for the mainstream media to confirm what institutions already know. The leaked $7.70 dinar forecast may be the early signal of a generational financial reset. Whether it materializes or not, this is a moment for action, not passivity. Currency history doesn't knock twice. Will you be ready? Disclaimer. This content is for informational and educational purposes only. It does not offer financial, legal, or investment advice. Foreign currency investing carries substantial risk. Always consult with a licensed financial advisor before making any investment decisions.